Hello, hello, Steve here. Let's talk about making money off of a stock market crash. So yesterday, the S&P 500 down by 2.41%. Tesla stock down 8.06%. ARK Innovation down 6.37%. And Bitcoin was also down big yesterday. Talk about good timing. I just released two videos, one on kind of the hot stock market, how it was looking a little frothy, and then I released a video on how I plan to invest in a market that's kind of seeming to be a little bit overvalued like this one. Now, I'm not going to say that I called this dip by any means because, we can't really predict the future, but I mean, come on, that was pretty good. Also, you'll probably notice that this mic right here, that's new. And it's a little bit of a teaser for some things to come in the future. Really exciting, but I'll just leave it at that for now. So in my last video, I talked about how I plan to use something called tail risk hedging to basically hedge my portfolio against large drops in the stock market. For those of you who aren't familiar, a hedge is basically a type of investment strategy that you set up so that if the stock market goes down, your hedges make a lot of profit. You can kind of sort of think of it like shorting the stock market depending on what type of hedge you actually use. If you remember the movie The Big Short, Michael Burry, played by Christian Bale, and all those other guys made a buttload of money shorting the stock market back in the financial crisis. What I'm going to do is kind of the same idea, but also very different in some ways. So today, I thought it would be a good time to walk you guys through the exact hedging strategy that I'm currently looking at. So first, we'll kind of start with the basic concepts of it, and then we'll work our way up to the actual full-on strategy. If that sounds good, let's get to it. So first of all, the effect we want to achieve here is this. When the stock market goes down, we want our hedge to be able to go up in value at the exact same time. This is great because we can then sell the hedge at a large profit and then use that profit to buy more stocks at a low price. But hedging your portfolio has a bit of a catch, and that's because, well, if your hedge goes up when the stock market goes down, then that means that your hedge goes down in value when the stock market goes up. So pretty much all hedging strategies have a cost associated with them. You can kind of almost think of them like an insurance policy, right? You pay insurance premiums on your car or maybe on your residence, and that basically protects it so that if there is some kind of adverse event, your insurance policy will probably pay out a huge amount, right, to cover that loss that you experienced. That's kind of the same idea as what a hedge is. But here's the thing. I've been tinkering with a strategy that should hopefully have a very low cost associated with it. It might even work out to be free or pay me a little bit to have a hedge, which is crazy for a hedge. And by the end of this video, you'll hopefully understand what I mean and be able to also try it out in your portfolio as well. So let's first walk through one of the building blocks of the hedging strategy I'm planning on playing around with, and that is the put option. Yep, we're talking options today, folks, but we'll keep it high level and I'll try and make it as easy as possible to understand. So, don't be shy if you're an options virgin. So in a nutshell, a put option is basically a bet that can be placed that says, hey, I'm going to guess that a stock will decrease in value by a certain amount and within a certain time frame. And to place that bet, you'll have to pay up some money in order to purchase a put option. For example, let's say there was a stock called Cash College and it was a great stock. Amazing, incredible, as Gordon Ramsay would say. And let's also say that you smacked your head one day and lost your mind and you decided you were going to short Cash College stock. And I don't know why anybody would do that because Cash College is obviously going to the moon. So we'll say CC is trading at $100 and you decide you want to buy a put option. And there's a put option available at a strike price of $99 and it'll cost you $1 to buy it. So you decide to go ahead and buy this. But options are a little funky, and that's because this put option doesn't really cost you $1, even though that's what the price shows. It would really cost you $100 because all option contracts represent 100 shares of the stock. So it's very important that when you're looking at option prices, that you remember to multiply the price by 100 to get the actual total cost of the option. And don't worry about this term, the strike price, for now. It will make sense in a little bit. Okay, so we bought our put option for $1, which really equates to a $100 bet for us. And we're betting that CC stock will go down. And fortunately for you, it does go down. But remember, this is hypothetical. CC ain't never going down in real life. So let's say it goes down to $98 per share. This is great for you because it passed your strike price of $99. You see, the strike price basically represents the price that you bet that the stock will fall below. And since you bought a put option at a strike price of $99, you're betting that the stock will fall below that. And in this case, it did, to $98. So let's say that your put option now is worth $2 or $200 when we remember to multiply that by 100. Hey, you just doubled your money. And in the world of options, this is actually completely normal. In fact, option prices swing extremely dramatically, much more than stocks. Just look at how much the value of these options on the S&P 500 changed in one single day. They multiplied 5, 6, 7, 10x some of them, all because the stock market had a decent drop yesterday. So if you got lucky and bought one of these put options a day before yesterday, you'd be up huge. But the catch is options also lose their value extremely quickly too. I mean, just look at these call options here. Now, call options are the opposite of put options. With a call option, you're placing a bet that a stock will increase in value. And since the market dropped a lot, these call options, lost a ton of value. So this is why I really want to caution you guys about trying options if you're completely new. They are extremely risky, and I'd really recommend paper trading options for a while. And paper trading basically just means getting yourself set up with like a fake money account at a brokerage so that you can try out options without risking any of your own money. It's a great way to practice, and it's a great way to learn. That's exactly how I learned how to trade options years ago. Okay, so put options are basically one way we can short the stock market and make a lot of money. Got that so far? But just buying put options isn't really the best strategy. And that's because options lose a lot of their value over time. And the reason they do is because of the second part of that definition I told you earlier. Remember, a put option is a bet that a stock will decrease by a certain value and within a certain time frame. And that's because all option contracts have an expiry date. So these put options I showed you earlier that went up in value by a ton, and these call options that lost a lot of value, look at this. These options expire in 4 days. This is why these options change in value so dramatically. Compare them to options that expire in 113 days, for example. You can see that they don't nearly rise or fall in value as much as the short-term options. This is very important to understand. Short-term options are very high risk, very high reward, and then longer-term options are a little bit less risk and a little bit less reward. But remember that all options in general are generally more risky than stocks. And because options actually have an expiry date, options can expire worthless, which means you would lose your entire investment. So always keep this in mind. And once again, I'd really strongly suggest starting out with paper trading, guys. So I personally don't plan on just using straight up put options to hedge my portfolio. Look at what happens to the value of puts over time. This is a put option on the S&P 500 SPY ETF with a strike price of $380 on a March 1st contract. Yesterday, this option increased by 787% from 33 cents to 252. So that looks pretty good, right? Like, why wouldn't I hedge my portfolio with that? Well, it's only really a good hedge if you bought that option yesterday. Let's pretend instead that it was around the end of January and you thought to yourself, I'd like to buy a put option 1 month out to hedge my portfolio. Well, this same put option would have cost you almost $14 if you bought it back then. And then as the month went by, your option slowly lost almost all of its value, all the way down to 33 cents before the bump up yesterday. So even though the option increased like 8-fold yesterday, you'd still be down huge on that put option if you bought it like a month ago. So all of this to say is that buying straight up call or put options requires extremely good timing, and that basically equates to having a good helping of luck. I ain't trying to rely on sheer luck for my hedges. So check this out. I'm about to drop something crazy on you. This, my friends, is how I'm thinking of hedging my portfolio. Now, don't let these lines and this crazy graph frighten you. It's all good. You got this. So what we have here is what is known as a backspread, or it's also sometimes called a ratio. You see, the secret to really unlocking the power of options is to do strategies that combine multiple options together. Basic calls and puts are all right, but they're basically just lottery tickets. Multi-option strategies are really where the good stuff's at. So here I have one near the money short call at a strike of 27 and two out of the money long calls at a strike of 42.50 to make my call backspread. For those of you who are new, I know you probably heard that and were like, what the did he just say? He's calling who back? Just watch this video a couple times and then go out and experiment with a few things paper trading, then come back to this video and I promise you that you'll learn. Options are an incredibly rich and deep topic to learn, but I think it's incredibly rewarding to also learn about them, but it just takes a bit of time and a bit of patience, but I really think you guys can get a really good handle of it. And for those of you who are a little bit more experienced with options, basically what I've tried to done with this spread is I've tried to match the short call and the long calls so that I get a small credit, or I just about place the trade for free on this spread. So this is a call backspread on the VIX, to be precise. Now, I'm not going to explain the VIX in this video because, well, this video would be way too long. That's a bit of a doozy. But basically, to put it simply, when the market goes down, the VIX goes up. So in this strategy, I'm betting on the VIX going up, because that means the market will go down. So here's why I think this is a better strategy than just straight up buying puts. In this platform I'm using right now, Thinkorswim by TD Ameritrade, they have a tool you can use to analyze option strategy. It's super awesome, and that's exactly what we're looking at here. So these four lines you see here swooping across the screen represent how much money I will make or lose on this trade at any point in time. The red lines here represent break-even points for each swoop, and these are estimates. They're not 100% exact, but they help get a pretty good idea. So in the bottom left corner, you can see the date that each line represents. For example, the blue line represents how much money I would make or lose once we reach March 17th, so a little less than a month from now. And you can see that the curves get deeper and deeper the further out in time we go. Now check this out. As we move to the right along the x-axis, we can see the value of the VIX increasing. So as we move right, it means that the stock market is probably decreasing. And we can see that the lines start to curve upwards quite a lot. And if we look down to the bottom left corner, we can see that as we move in this direction, the profit on this trade increases dramatically. And ultimately, that's what we'd be looking to hit with this strategy, right? A huge increase in the VIX because of a big drop in the stock market, and then I'd earn a big profit here. But there is a risk with this trade. And as you can see, between about 20 or so and then 57 on the x-axis, we have this valley here. And here's where I would lose money depending on the date that we're at. This is the valley of death. And the valley of death gets worse the more time that passes. You can see here the max loss on the trade is around $1,092 about if the VIX was at 42 by the time we reach March 16th. Yikes. We don't want that to happen. But fortunately, there's an easy way to avoid this. You simply roll your strategy forwards before you get within 30 days of your options expiring. Because look, if we roll this strategy out on April 6th instead of May 16th, look, we only face a max loss of around $80. That's a huge difference. That's way less than 1,000. And for those of you who aren't familiar, rolling options just means closing your trades and then replacing them out further in time. So in April, I might close these options and then replace them a few months out in July or August. And rolling your strategy like this prevents you from ever getting hit with these big losses in the valley of death. And for those of you who have a bit of experience with the VIX and with options, you may have noticed something. If we look to the left side of the chart, we can see that the lines swoop back up to hover around the break-even point, and then they actually turn a profit as we continue to go lower. Aha. Now here is another part of the magic of this strategy. As some of you may know, the VIX actually tends to always be drifting downwards normally. If we look at a long-term chart here on the VIX, we can see that the VIX spikes up dramatically when there's crashes like in COVID, but then afterwards it quickly falls and then resumes slowly tracking downwards over time. So with this strategy, you're actually playing into that downwards grinding effect of the VIX, basically giving yourself a good chance that at some point while you have this trade on, you're going to be able to roll this trade to a new month either for free or at a break-even point, or even for a small profit, which, yes, means that you can hedge your portfolio with this either for free or a small profit if you manage this trade carefully and the VIX works out in your favor, which statistically it probably should at some point when you have this trade on, if you put it on to basically cover maybe like a quarter of the year, something like that. And this is so incredibly powerful because hedges usually cost you a lot of money to maintain, like that insurance policy you have on your car. And so, my friends, this is the magic of the call backspread on the VIX. Now, I'm going to continue to play around with this strategy a little bit, see if I can tweak it to fit my needs best. I haven't put one of these on yet. I've just been kind of analyzing them, and I put one on as a paper trade recently just to kind of see how it actually reacts to the market in practice. But hopefully soon I'm going to put one of these on and make good use of this type of hedge this year. If you enjoyed this video and you'd like to help support the channel, consider checking out some of the links down below, like signing up for Webull, where you can get 2 free stocks valued up to $1,850 when you deposit $100 into a new account. Or if you're Canadian, check out Wealthsimple Trade, where you can get $10, and Newton, where you can get $25 when you trade $100 worth of crypto. Also, if you did enjoy this video, you may also enjoy checking out the video where I talked about my overall strategy for investing this year, and I'll make sure that pops up somewhere on the screen right now. And also consider subscribing to the channel if you're not already. Now, I feel like I have to do another disclaimer here at the end that options are extremely risky. I really recommend starting with paper trading. And also maybe a disclaimer that none of this was financial advice. This is just what I am doing with my investment strategy this year. So this is just me sharing what I'm doing. Okay, disclaimer done. Thanks for watching. Bye-bye.